Hey everyone, and welcome back for another deep dive with us. Today we're going to be tackling how the upcoming U.S. election could really shake things up when it comes to market risks and what that might mean for the Federal Reserve.
Sounds pretty intense.
It is. Especially since, right now the market seems super optimistic. I mean, look at the numbers, the Dow Jones, NASDAQ, S&P 500, they're all climbing. And the Russell 2000 is even up like over 1.6%.
Yeah, it's been a good run, for sure.
Right. But you know me, I always like to look under the surface, and things there aren't quite so rosy.
Yeah, I'm with you. There are definitely some mixed signals out there right now. Like, take the fear and greed index, for example.
Oh, yeah, that's basically like a mood ring for the market, right?
Pretty much. And right now, it's flashing greed, which means investors are feeling pretty confident.
So everyone's feeling good. What's the problem?
Well, at the same time, we're seeing fewer stocks hitting those yearly highs, and that could be a sign that this bull market, all this growth, might be losing some steam.
Interesting. So it's like everyone's at this party having a good time, but they're kind of keeping an eye on the exit just in case things go south.
Exactly.
And then, to make things even more interesting, we've got the Fed watching all this unfold.
Ah, yes, the Fed.
And wouldn't you know it, Nick Tamaros, he's like, I don't know, the Fed whisperer, right? Is hinting that they're seriously thinking about how the election could throw a wrench in things, especially when it comes to inflation.
It's true. The Fed's been working hard, aggressively hiking interest rates, trying to keep inflation under control.
Right, right.
But what Tamaris is saying is that whoever wins this election, their policies could either help the Fed out or totally undermine everything I've been trying to do.
Okay, hold on. I need to catch up. So what kind of policies are we talking about here, and how could they mess with the Fed's plans?
So think about it. What if we see higher tariffs on all those imported goods or big cuts to immigration or, significant tax cuts? Those are all things that have been thrown around during the campaigns.
Okay, I see where you're going with this. These policies might be popular with some voters, but they could also have some, let's say, unintended consequences, right?
Exactly. Higher tariffs mean stuff gets more expensive, driving up the costs of goods. Immigration cuts could lead to labor shortages, which again could push inflation higher.
Right, right. Less people do the work, wages go up, prices go up.
Exactly. And then tax cuts, while they sound good, might stimulate the economy for a bit, but they could also lead to, well, more government borrowing. And guess what? That could mean even more inflation down the line.
Wow, okay, so the Fed's basically walking a tightrope here.
Pretty much. They're trying to figure out, what's going to happen after the election, how they're going to have to adjust their game plan, all to keep this inflation monster in check.
Sounds stressful. It's like they're trying to hit a moving target while blindfolded.
Haha, yeah, something like that. And it's not just the Fed that's feeling the pressure. We're smack dab in the middle of earnings season, and let me tell you, things are getting interesting.
Oh yeah, earnings season. That's always a fun time.
You said it. About 37% of the companies in the S&P 500 have reported their earnings so far.
Okay, and
And there's a pretty clear trend emerging. The whole beat expectations, your stock goes up, miss expectations, and it takes a nosedive thing.
yeah, the classic Wall Street dance.
Exactly. Companies that are exceeding those analysts' expectations, their stock prices are climbing. Which makes sense, right? That's what we expect.
Makes sense to me.
But here's the catch. Those companies that are missing expectations, oh boy, they're getting hit harder than usual this time around.
How much harder are we talking?
We're talking an average drop of 3.6% compared to the 5-year average of 2.3%. That's a big difference.
Ouch. That's a pretty significant hit.
It is.
What do you think that tells us about how investors are feeling right now?
Yeah.
Their overall sentiment.
Honestly, it tells me they're getting more selective and maybe a little more, I don't know, nervous.
Nervous about what?
Well, they're definitely rewarding companies with solid performance, but they're also super quick to punish those that don't quite measure up.
So high stakes, basically.
Absolutely. And, if you look at the big picture, the overall earnings growth expectations for the S&P 500, they've actually been adjusted down to 4.3% for the year,
Count from what?
down from that recent average of 8%. And that, to me, well, it paints a picture of, I'd say, waning confidence in economic growth.
I see your point. It makes you wonder, what are all of you seeing in your own portfolios? Are your investments mirroring these trends? Something to think about for sure.
It is. But hey, before we spiral into an existential crisis over our investments, let's shift gears a little bit. How about we talk about some key economic indicators coming up soon?
Okay, yeah, sounds good. What are we looking at?
We've got the ADP and non-farm payrolls reports on the horizon. Those always get everyone buzzing.
Why is that?
Well, they give us a really good snapshot of job growth in the U.S., which is a key indicator of how healthy the economy is doing overall, you know? Remember last month when that jobs report surprised everyone? Came in at a whopping 250,000 new jobs?
Yeah, I remember that. Everyone was pretty shocked.
Right, so you know everyone's going to be watching closely to see if that momentum keeps going.
And how this all plays into the Fed's decision-making, right? Especially when it comes to those interest rates we were talking about earlier.
Absolutely. If those jobs reports come in hot, it could give the Fed more reason to continue raising rates to, try to tame inflation. But if we start seeing signs of weakness, it might make them think twice. And then, of course, we can't forget about the elephant in the room, the election.
Right, the big one.
Historically, election cycles tend to add a whole lot of volatility to the market. Things get a bit rocky.
Especially with the polls showing such a tight race between those presidential candidates, right? Feels like no one knows what's going to happen.
Exactly. It's uncharted territory, and that uncertainty, well, it makes investors nervous. So buckle up because the market could react strongly once those election results start rolling in, especially if the Fed decides to make a move on those interest rates in response.
Sounds like we're in for a wild ride.
Yeah, it's going to be interesting to see how it all plays out.
No kidding. So, okay, we've got all this short-term stuff, the earnings season, the election, all adding to that market jitteriness. But what about the long game? What are some of those bigger, like, looming shadows out there that could impact the economy down the road, regardless of, who wins in November?
Well, one big one that keeps me up at night is the growing national debt. It's a big one.
It is a big number, yeah.
It is. And we're kind of looking at this scenario where the Treasury might have to issue a lot more debt to cover all that, government spending. And that could put some serious upward pressure on those interest rates.
Okay, so help me connect the dots here. How does more government debt lead to higher interest rates for everyone?
Well, it boils down to supply and demand, really. If the Treasury, they start flooding the market with more bonds, which is how the government borrows money, then investors might start demanding higher yields to make up for the perceived risk.
Right, so it's like if there's more of something available, the price usually goes down.
Exactly. And when we're talking about bonds, a lower price, well, that means a higher yield.
Okay, that makes sense. So basically the government have to like sweeten the deal to get investors interested, which then means higher interest payments for, everyone else down the line. Businesses, regular people like us.
Exactly. And it's not just, the folks here at home we got to think about. If those overseas investors start getting spooked by the U.S. fiscal situation, they might start pulling back from, those Treasury investments, and that could drive yields up even further.
And higher yields mean?
Higher borrowing costs. For everyone, businesses, you and me, you name it, that effect, it kind of ripples through the whole economy,
Yeah, that's not a ripple I want to be caught in.
Right. But hey, listen, before we go full doom and gloom on everyone, let's talk about something a little more exciting. Have you heard about Meta's plan? They're trying to develop their own AI search engine.
Oh, yeah. I did read something about that. They're basically trying to, break free from Google's on the whole search market, right? It's a pretty bold move, if you ask me.
Bold is an understatement. Meta's got this, this massive user base with Facebook, Instagram, WhatsApp. Billions of people. If they can somehow leverage that, actually create a real search alternative, it could be huge.
Yeah, that would be a game changer. Imagine what that would mean for investors if they pull it off. But speaking of making big moves, the Treasury's been doing some interesting stuff lately with their borrowing plans, haven't they?
Oh, yeah. You're talking about that $19 billion reduction in their fourth quarter borrowing.
Yeah. But then they turned around and announced they're planning this record $823 billion haul for the first quarter of next year. Pretty big swing, don't you think?
It is, and it'll be pretty fascinating to see how the market reacts, honestly. I think a lot depends on how that debt's structured,
Yeah.
Will it be mostly short-term bonds, or will they go for, the long-term ones?
Right.
Because that decision it impacts bond yields, which then can influence those equity valuations. It's all connected, like a big web.
Yeah, it's a lot to keep track of, that's for sure. So, okay, here we are, standing on shifting sand, right? So many moving parts, the election, the Fed, the national debt,
Yeah.
and now we've got, Meta shaking things up in the tech world. I mean, what does all of this mean for, the average investor just trying to make sense of it all? It feels kind of overwhelming.
It's definitely a lot to digest, and it really highlights how important it is to, to stay informed, to stay
So
adaptable.
advice?
It is, but, even with all this uncertainty, there are still a few key takeaways I think investors should keep in mind, at least as we head into this election and beyond.
Okay, so give us the rundown. What are the most important things investors should be thinking about right now?
Well, first and foremost, be prepared for some potential policy-driven inflation, once the election dust settles.
Okay, that makes sense. I mean, depending on who wins, obviously, and what policies they decide to,
It varies
prioritize.
We could see some upward pressure on those prices, and that means the Fed, well, they might have to delay those rate cuts everyone's been hoping for in 2024.
So, no relief in sight for those of us feeling the pinch of higher interest rates.
It's a possibility, yeah. Remember, the Fed's main job is to keep inflation in check. And they've made it pretty clear that they're willing to do whatever it takes to get that done.
I mean, true.
So if inflation starts heating up again, well, they might have to just stay the course with those rate hikes, even if it means, slowing things down a bit, slowing down economic growth.
Okay, I get it. Makes sense.
Yeah.
So what's your second takeaway for investors?
I'd say given that, those overall earnings growth expectations are lower and the market seems to be like really rewarding those companies exceeding expectations, I think it makes sense to focus on companies with really solid earnings fundamentals.
Okay, so basically quality over quantity.
Pretty much.
Yeah.
Don't chase those flashy bets that could go either way. Look for companies that have a strong track record.
So a history of profitability and like a clear path to growth in the future.
Exactly. And the third thing to remember is that, well, election-related volatility, that's almost a given at this point. So we could see some pretty big swings in the market as those results come in, especially as those policy implications become, a little more clear.
So any advice on how to ride out this storm without getting totally seasick? How do we deal with this volatility?
Well, I think if you're in it for the long haul, if you're a long-term investor, the best thing you can do is probably just stay the course.
Right.
Market fluctuations, they're normal.
Right.
And honestly, trying to perfectly time the market, that's almost impossible.
Yeah, good point.
But if you have a shorter time horizon or you're just feeling a bit more risk averse right now, it might be worth it to look into some hedging strategies.
Yeah.
Something to help reduce that near-term risk.
Yeah, that's a really good point. And of course, it's never a bad idea to talk to, a financial advisor and see what makes sense for you specifically. Your situation, your risk tolerance, all of that. This has been it's been a really insightful deep dive. We've covered so much. It feels like we've traveled the world from the Fed trying to walk this tightrope with interest rates to the potential for election-driven inflation.
Yeah.
And even Meta trying to shake up the entire tech world. It's a lot.
It has been a lot, but it's always a pleasure diving into these topics with you.
And to all our listeners out there, thank you so much for tuning in to the deep dive with us. We really hope you found this exploration of market risks and opportunities,
Right.
especially as we head into this election, informative.
Yeah.
Something to really think about.
Definitely a lot to think about.
It is. And don't forget to subscribe to the show and leave us a review if you're enjoying it. Until next time, stay curious and keep diving deep.